This podcast is brought to you by True Resources, connecting talented people with the best mining employers in the Australian market. For more information, head to trueresources.com.au. So, hello, I'm Ben Kostrich, and this is the Market Bull podcast. I'm extremely grateful today. I'm speaking again with David Hunter, the Chief Macro Strategist at the Contrarian Macro Advisors. He's a big name with over 50 years in Wall Street. We last spoke in December of 2023, and we're talking about a melt up in the markets, and there's clearly been a lot that's unfolded and changed since then. So welcome back, David.
Yeah, hi, Ben. Good to see you again.
Yeah, it's been a turbulent time in the markets. And if we flash back to when we last spoke, you were talking about a melt up, and you were, I guess, out in the cold to some extent from other people's opinions. But as it came right, you were pretty spot on with some of your predictions and what was unfolding. So remind us a little bit of what your original calls and predictions were, and even still now how they've slightly adjusted with the current market conditions, particularly in the US.
I'm sure. Yeah, going back, the market bottomed in October 2022, and we had a sell off based on, I think, some economic number. It might have been CPI, but something back then, and the market sold off very early that day, and then reversed. And I said, looks like we bottomed. And at that time, everybody was looking for much lower. There was calls for 3,200 on the S&P and even below 3,000. And it turned at 3,500 and hasn't looked back since. That first year out of that, we climbed a real wall of worry. There was a lot of skepticism that the rally, whatever it was going to be short-lived, and then we returned to the lower lows that everybody was expecting. So all the way up until we basically got to, say, 4,300 from 3,500, people were very skeptical. Above 4,300, there was some beginning to doubt their bearishness, and at least reluctantly climbing on, saying it looks like this thing has legs. But still, they expected maybe back up to, 45,600. It got up there and then had a sharp correction down to 4,100, which it was pretty clear that was coming. So I mentioned it, and then turned at 4,100. We really have run all the way up to the mid 5,600 area. And it was only once we went to new highs above 4,800 that we started to see more people realizing that we're not going back down, to where we were. We're, made a lot of corrections along the way, but we're not going all the way back down. So people have reluctantly climbed on. We had a pretty sharp correction in the summer of 2023 into the fall. In October of 2023, we had a secondary bottom, that was at 4,100 area. And we've been very strong since then, all the way up to, as I said, 56.50 or thereabouts. And of late, as you know, in early August, we had the yen finally, after years of being under pressure, it reversed itself. And an awful lot of hedge funds and others were using the cheap money in Japan to fund purchases over here and elsewhere. And so when the yen turned up, it meant your cost of carry was going to go up a lot. So there was a very rapid unwind of that so-called carry trade, yen carry trade. So that caused, a very sharp correction in early August. And since then, we had a good rally off of that. And of late have been kind of consolidating that rally with lots of calls for, this rally. It feels a little bit like 2022 again, where people are doubting this rally has legs. They're calling for a double top. They're saying this thing's going to hit, sharply south. So there's still, again, a lot of skepticism again. When they turned bullish above 4,800, I called them reluctant bulls. They basically were there because of the tape and had very little conviction. So once it started running into resistance and rolling over, they were easily persuaded to go bearish again. And that's where we stand now, I think, is It's not bearish like it was in October of 2022 or even October of 23, but it is bearish. It is nervousness, not a lot of conviction that this thing can go a lot above the old high. If people do have higher expectations, it's 100 or 200 points on the S&P higher, not. My forecast changed in my January letter of this year. I raised my target for the S&P from 6,000 to 7,000. I raised my target on the NASDAQ from 23 to 24,000. I think I did that later than last January, but I raised my Dow forecast in January from, I think I had been at 45 or 48,000, raised it to 55,000. And that's where I stand right now. My Russell target, back then I raised it to 3,300. It had been 3,000. So I'm by far the most aggressive bull on the street. I think we could see those numbers this year, maybe even by our election, not necessarily, but because I think we're going to have a very steep final run into a top. It can happen quickly. It doesn't mean it can happen in 2 weeks, but it can happen in 2 or 3 months. Doesn't have to. Even if it does it in 4 or 5 months, it's a very steep rally. But I think the odds are pretty good that we're going to see it this year. And that from to go from 3,500 to 7,000 in a little more than 2 years is that's what I call a melt.
Yeah,
that's a melt up. So that's what I mean by a melt up. It's a bull market. People get caught up in the phrases, and I use the term melt up and been using it for probably 5 years, 5 or 6 years, to define what I thought the end of this cycle would look like. It would be parabolic. It would be very steep. But people say, "Oh, I don't call this a melt up." I said, "I don't care what you call it. It's a bull market, a very strong bull market that's going to end in a steeper rally into the top." So, it's funny how people want to determine that they can define a term that I used and nobody else was using, but that's okay. I mean, and I think it will be driven by lower rates. I've been the most bullish on bonds of anybody out there. I've been forecasting that we could see a 2.5% 10-year this year. And then in next year's global bust, it could fall all the way to 0%. Nobody's even close to that. Most people think rates are, not going to go a lot lower than this, and then they go up again as the economy, as inflation reignites. My view is we're going to see a global deflationary bust next year, so actual deflation in the economy, and that's why I think rates can come down. Central banks are they're going to start slowly. They're going to be reluctant to ease, but they're going to start slowly. But as this thing really starts to head south, this meaning the world economy, I think you're going to see them have to get very aggressive. So you're going to see a lot of new money, new QE, big rate cuts, all of that next year. This year, I think rate cuts are coming. For the Fed, I'm expecting, it's between 1.25% for the Fed this year. I mean, this September. I think it's pretty foregone conclusion they're going to cut. It's just a question of which. I don't think they go beyond a half. So it's either a quarter or a half. My guess is it'll be a half because the Fed is very behind the curve. If you look at where market rates are and then look at where the Fed rate is, where the Fed funds rate is, which is Fed sets, it's 150 basis points behind the market. So they're not going to do 150. And as I said, I don't think they're even going to do 75, but I do think that they can. They will see the need to do a half a point, do 50 basis points. And I hear lots of people saying, if they do a half, it's going to show panic. It's going to show that they see something we don't realize. I don't know. If you're that far behind the curve, you have to start cutting more aggressively than a quarter. and you can explain it. I mean, people act like there's no nuance in terms of explaining things. You can say this isn't a cut because we see the economy tanking. We don't. We think it's a soft landing, but it's a cut recognizing that our policy rate is far behind where it should be. We need to get closer to where the market is. That's easy to explain. And frankly, they can also explain it from the standpoint that inflation is moving ever closer to their target. So I just don't understand this idea that, boy, if they do a half, people are going to panic. I think quite the opposite. I think, people will be pleased to see that the Fed gets it.
Yeah, and I mean, with some of your targets, naturally, it'd be good to elaborate that this isn't without potential pullbacks. I think a lot of people get carried away that 24,000 for the NASDAQ doesn't mean that it can't have intraday or intra-week sort of pullbacks, which is sort of an expectation across markets. And I always look to previous cycles, and it's very hard to draw, I guess, relations to previous bull markets because of what's happened previously with the pandemic and this overstimulus of cash. But with the US election coming up, and as you said, with the Fed meeting some point in September, there's a few catalysts that could potentially propel markets in either or directions. How do you sort of see those potentially impacting which way it goes? And I know in the US, both parties have got very different policy agendas, and investors are always sort of taking those into considerations, but you always like to say Wall Street's always a few steps ahead anyway. So do you think that there's already some of that being factored into some of the movements at the moment, or what's your thoughts on that?
Yeah, I think the odds are now. Again, I tell people I can't precisely predict the path to the top, and so I don't really try. But I think the odds are that the 8.5% correction we saw in the S&P in early August, is probably, we're not going to see another one of those until we get to the top. We could have 2, 3, 4% pullbacks at any time. That's, when you're up in the stratosphere like we are, looking at it from a bigger picture, 3 and 4% corrections can happen based on anything. So I think the odds are that any pullbacks will be short-lived and be, relatively small. I was surprised, obviously, in early August. I wasn't expecting us to even see that big a pullback. I thought probably 5% might cap it, but markets do what they're going to do, and we had a carry trade unwind that couldn't be anticipated. So anything like that could cause a bigger correction. But I think the odds are we're entering the parabolic stage, which means it's going to be mostly on the upside. Corrections, pullbacks will be daily, maybe weekly, but not much more than that. Again, that's my guess. That's not, I can't precisely know that. So, people go, "Oh, you didn't think this was," I said, "No, I can't precisely tell you how the exact path it's going to take to the top, but I'm pretty, my convictions are high that we're heading for 7,000. And so, I think between now and the election, maybe between now and the end of the year, I would not spend too much time worrying about, exactly what size pullbacks we're going to have. And I would use pullbacks as entry points if you're going to enter. I have caution. We are in the last inning of a 42-year global, secular bull market. Started back in August of 1982. Dow back then was 800, 780. So the Dow's up in the 41,000 area. Shows you how far we've come. You have to recognize that risks rise as you get closer to the end. No matter what, I can be wrong. The top could happen anytime and roll over. That's not as I said, I have a high conviction. We have a lot more to go here, but that doesn't mean I know that. That's my forecast. So risks are rising because you're within months of a top, in my opinion. So whether it's 2 months, whether it's 3 or 4 months, you're within months of a top. And even if even if it still has 30 or 40% to go, um, it's short term. You're talking about something that we haven't seen. That kind of a return in that short of time is unprecedented. So there are ways, it may not happen. It might only do half of that. It might have something come out of left field, geopolitically or otherwise,
Mhm.
that causes it to roll over prematurely. So people have to know that when you're in the stock market, you're talking about uncertain events, things that carry risk with them. And even if I have high conviction, it doesn't mean I have a crystal ball and I know. So, I've been pretty right this last 2 years, and before that was pretty right on the earlier um, melt up in 2020 and 21. So, people have confidence. Some people have confidence in my call, but again, the markets will do what they do. So I can give you a high conviction forecast, but I can't say it's 100% going to happen. And I know people will watch this and say, you sound like you're losing some of your conviction. No, not at all. I'm just trying to caution people that are relatively new to markets
Mm.
that nobody knows for sure. And we are late in the game,
Yeah.
late in the bull market. So, um, but my forecast is that we have perhaps the biggest rally in history still ahead of us in terms of the amount of ground that's going to be covered in a relatively short period of time. So it makes it a kind of a quandary for investors because you have to be nimble.
Mm.
If you're going to play a 3-month rally and you're late, you say, well, or if you have to also know yourself. Let's say you play that 3-month rally and then at the top, you get greedy because you say, wow, this thing
Keep going.
ain't in, and then it rolls over. The market may not be very forgiving if you're late. So for all those reasons, I'm just kind of putting out a cautionary note to people because we are getting closer to the end that, you may want to begin hedging your bets at some point. I don't give advice,
Mm.
but I'm just kind of giving you some philosophy that, you know, don't think you're so smart or don't think I'm so smart that I'm going to be able to ring a bell and tell you this is the day it ends.
Yeah.
It's just not going to happen that way. So, but that being said, yes, I'm still aggressively bullish for both stocks and bonds. The rates are going to be coming down. The bond market has led the Fed. So the Fed hasn't eased yet. They're probably going to ease in a couple of weeks. But the bond market certainly has eased for them. We've had the 10-year dropped from 5% last October down to 370 something now. That's almost 125 basis point cut in rates because the 10-year does carry a lot of clout in terms of setting loan rates, credit cards and various things, housing, mortgages. So we've already had a big easing, even though the Fed hasn't even begun to ease. And people don't understand that. Though I'm much more interested in what the bond market's doing than whether the Fed's going to cut or not. That's why I have been pretty bullish in terms of what rates would do and how that would help the market. The dollar has begun to roll over. It's very early in what I think is going to be a sharp correction dollar. We're at 101 and change on DXY. I think it can drop down to 80 probably over the 6 to 9 months. So it's not going to coincide exactly with the market top. But I think overall, or even the global bust, it could continue to fall early in the global bust. So, but I think there's a big decline coming in the dollar, which means for you guys over there, versus the US dollar, the Aussie dollar, I think will climb.
Mm.
So I've got an Aussie dollar versus the US dollar. My target is 85, 0.85 on that. And I think it's in the 60s now, 68 or wherever it is, 66. I'm not sure,
Mm.
but But so there's a good climb ahead for the Aussie dollar, I think, versus the US dollar.
Mm. And interesting, the other side of it, when we do have these market pullbacks, there's always particular, I guess, commodities, and this is alluding me to precious metals, because we haven't touched on gold and even silver to that extent. Gold at the moment is sitting all-time highs, US dollar per ounce. I haven't checked silver more so recently, but how are they also performing on that grand scheme of what's happening in the commodities and stock side of things? Because yeah, gold just continues to go, and anytime there are potential, how do you say, fear indexes in the market, gold seems to rally, and it's been rallying for, well, years as well. So what are your thoughts on the precious metal side of things?
Yeah, you have different people having different perceptions of gold, because I get a lot of people saying, "What's wrong with gold? It's not moving enough." I go,
Mm,
"You're at all-time highs, or
yeah.
we're at all-time highs. We've been consolidating here for a little while, but basically we're almost virtually, we're almost at all-time highs, and looks like it's poised for another run." I've got 3,000 as a target, and I'm likely going to raise that very soon, by several $100s. So I think gold looks great. It's, you've got geopolitics out there that certainly fuel some of it. You've got demand from, the BRICS, particularly Russia and China buying gold.
Mm,
There's talk about them backing a currency with gold, et cetera. So there's plenty of reason for gold to have a bullish look. And besides, it consolidated for many years before it started moving up from 1650 a few years ago. So I think it looks very bullish, and obviously have a pretty aggressive target here ahead. Silver, on the other hand, has been a much tougher metal for people.
mm,
And, it peaked out in 2011, and at 48, I think. It hasn't seen anything close to that since. So it's up in the 28 change area, almost 29 now. Had a nice run today. I think silver, and ironically, silver's run from the low 20s, maybe 22, up to 32, and then has backed off, for the last month or so, consolidating that run. And maybe been a little longer than a month that it's been consolidating. And all the bears come out of the woodwork again saying, it's
mm.
going nowhere. I said, you had a,
Decent run up.
50% run up, give it a chance to breathe.
Mm,
So I think it's pretty much run its course on the consolidation, is poised for another run. I have a very aggressive target on silver. I had been saying 60 probably when I talked to you last.
yeah, yeah.
Uh, but I've raised that to 75. I think I raised it in July, because I think there is legs to it. So it's slower to catch up. It has other things troubling it. Gold has, is more of a flight safety metal. It has the currency side. Silver's kind of a poor man's gold, but it also
Mm,
has very cyclical characteristics. So it doesn't always trade the same way gold does. I think, though, right now we're on the verge of a very big run in silver, a catch-up run in silver. And obviously, if it breaks above 48, it'll be new highs there too. So you'll have both gold and silver in a secular bull market. A lot of doubters out there, I think, because silver has been so disappointing, and maybe even more than silver, the miners.
mm.
The miners have just not given you anything. So there's a lot of people that have given up on the miners, or just are very skeptical that they can do anything. Every time they lift their head, they correct again. So, but I do feel like there's a big catch-up rally coming in the miners, within the next, in between now and the end of the year, probably spills into the first quarter of next year.
Mm. And I think I haven't yet to see a great silver run. 50% recently is great, but I'd heard stories of silver, as soon as gold starts performing, silver tends to outperform. But again, as you said, it's the poor man's gold. So there's never really as much attention unless you're directly looking at it. And yeah, the base on the way that gold is going, and yeah, the frustrations. It's quite ironic to hear it, given that it is all-time highs and it just continues to power on. But there's just so much unfolding across the markets, and you mentioned it earlier about the soft landing. I haven't heard that term in months now, at least being on the Australian side of things, and talking about the Feds potentially easing back interest rates. And there was always that talk for the last 2 years, almost every day you'd hear soft landing. Have we got a soft landing? I mean, looking at it now, do you feel that the US in particular has managed to get some form of soft landing? And then what are the next implications that happen into 2025, as you talked about, a bit of deflation and probably a strong pullback potentially on the horizon as well?
Yeah, I'm in a funny place because I have both the most bullish forecast out there and also the most bearish forecast out there calling for a global bust.
Mhm.
It's a dire forecast for
Yeah.
what I think will be next year. We have to see where we go, how long it takes to get to the top here, et cetera. But I'm calling for an 80% bear market next year. Could start before the end of this year, but certainly most of it will be next year. Um, and a global bust, which I define as something that'll feel like a depression, be bigger than 2008-9, happen the speed of a recession, but feel like a depression. So it's not stretched out over a decade or
Mm.
half a decade, but it will do a lot of damage, and it'll come with a global financial crisis that could exceed 2008-9. In fact, I expect to exceed 2008-9. Um, so basically the biggest in history. Um, and and yet, even though I'm saying that, I'm saying the narrative that carries us to the top is a soft landing narrative,
Mm.
because we're not seeing right now, we're not seeing the things that would tell you that we're going to have a global bust. So I'm looking at other things that are, you know, um, the fact central banks are way behind the curve, et cetera, that with the lead times tell me we're going to have trouble. And basically, the reason I say worse than 2008-9 is because the leverage around the world is much bigger than 2008-9. So, 320 trillion in global debt, quadrillions in notional value of derivatives. So you have leverage on the markets in terms of derivatives, leverage on the system in terms of debt. Leverage on the way down really exacerbates things. And I don't think people realize how much leverage can not only speed things up, but also magnitude wise make things much worse. So that's what the bust is based on more than anything.
Mm.
Timing timing it's harder because we're not there yet. I mean, people want me to know when it starts when we don't have the signs yet that we're even in it. Right now, it's easy to make a case that the Fed has managed this thing very well, that they have stayed on the tight side without jeopardizing the economy, meaning, we just had 3% second quarter in the economy. And the projections right now are for a 2% third quarter. That's not recession.
Mm.
Now, there are parts of the economy, manufacturing in particular, that are struggling and are probably in recession. But the service economy is still holding up. The consumer, although stretched, is still spending. Um, there are troubling signs. Savings has been drawn down after the spike it got during the pandemic. It's been drawn all the way back down. There are credit card delinquencies that are rising to levels that have in the past predicted recessions. So there's troubling things out there, but people who don't do this for a living want to take those things and say it's imminent. No, those
Mm.
things are precursors of things to come, but they evolve. They don't happen all at once. And so I think we've got a runway here that says soft landing can be a legitimate narrative for months still, um, but that the danger signs are starting to increase. That soft landing may morph into something worse, but it's still a may. Now,
Mm.
maybe. In my mind, I conviction that we're going to have something much worse next year. But, for most people, and the reality that my forecast is a forecast, not a I know.
Written of law. Yeah.
People should be paying attention to what is out there now, not what I think. And what is out there now is a soft landing scenario. We had a weak jobs indicator today. It's not the jobs number, but one of the leading things today that is causing people to say, "Oh, see, we're in recession." I go, it's premature to take a number like that. It's not even the jobs number itself. It's what it might be predictive of 2 days from now. I don't think you're going to get that. I think you're going to have soft landing numbers. And even if not, it's one number. Now, last month, which was the late July, early August sell off in the market, you got a weak jobs number, and everybody jumped on it, said, "Oh, here we go," and then we had the carry trade unwind. So, but some of that was due to a hurricane that there were a lot of people that were out of work in the Gulf region because of the hurricane, et cetera. So I just think too often people, we have, because of social media, we have all kinds of people out there who think they can be economists or think that can look at day by day numbers and have an opinion. They don't understand how this stuff happens. I've learned through many cycles that things can look like they're rolling over, and it may take a while to get there. So I think the scenario that gets us to the top is going to be soft landing, lower rates, maybe much lower rates, meaning on our way to 2.5, lower dollar, and a sense that the Fed has done its job pretty well. And again, all through this last couple of years, the Fed's taken a lot of flack for,
Hasn't it?
and I'm calling for a global bust, and yet I'm the guy defending them. And I'm the one saying they're way behind the curve, and yet I'm defending them, saying, based on what you see today, they can't be faulted. They did this thing so far. It looks like they did it right. It's just you may only be halfway through the book.
Yeah. I think your points there so important, especially about access and understanding that just by looking at it on a day-to-day, you're not going to get the full bigger picture, and especially with the prevalence of social media. And it's amazing now seeing just the unwillingness to even fact check or double check or scan something. A podcast like this is great, but also use other sources of information to cross-reference and listen and read, I think, is another really important thing. And
yeah, it's a fine line you have to walk between, I'm forever saying on Twitter, ignore the noise, which is the day-to-day chatter. You can go on CNBC or wherever and have all kinds of opinions. You have to learn to filter out a lot because there's a lot of opinion out there. But on the other hand, know how to filter in some of it so that you can at least be, kind of guided by some stuff. I can't even instruct people exactly how to do that. It comes from experience, but you kind of know what to pay attention to and what to ignore. And I'm forever on Twitter telling people to stop watching the market day to day and try to derive results from that. In other words, today the market's selling off and people get very bearish. And I go, the market's going to go up and down day to day, and you're going to have short-term pullbacks, day to day, week to week. But trying to derive judgment from that is a fool's game. I mean, it just does not make a lot of sense. Now, that's not to say there aren't people that can read charts and trade off charts, shorter term charts and stuff. But in terms of trying to understand the melt up scenario or a bull market into a top and what follows that, day to day is a fool's game. You just need to, most people, not everybody, but most people would benefit from turning off their screens and not looking at it so closely. If they would only look at it once in a while, instead of being glued to it every day. And, I see their emotions. They go up and down with the market. That's a sign that you are counterproductively doing, that the watching of the market is counterproductive because going up and down with the tape is exactly what you don't want to do.
Yeah, it's an exhausting process, and yeah, I've heard a few people. There's a great guy that I've interviewed, Tony LeCantre in Perth, and he said that the easiest way to get around this now is either go to jail or lose your password to your phone so you can't access any of your stock trading accounts. It somewhat is that if you're checking it day to day, there is so many stresses, and it's a loophole and just a plunge that you make. But speaking of, access to information, I know you're one of the most prevalent Wall Streeters on Twitter. I think you reply to almost everyone if they mention or tag you. And I see you have, again, great conversations with people, and of course, silence all the trolls, which there's no shortage of them nowadays. But how can people keep up to date with what your predictions and your movements are, and potentially a letter as well that you mentioned at the outset?
Sure. Yeah, I am on Twitter virtually every day. My handle is at Dave H. Contrarian. And make sure that Contrarian is spelled properly. Somebody the other day had in the IAN, they had J, and Contrarian. There are lots of people out there trying to trick you and get you to follow them, and some of them are trying to scam you with, take your money or whatever, but a lot of them are just there to be a nuisance.
Yeah.
But I only have one account, and I've got 205 or 6,000 followers. So the best thing to do is look at that. If you don't see that, if you see 1,000 followers or hundreds of followers, it's a fake account. I also would tell people, I get this, and I've noticed this lately, is people go, I haven't seen you in a long time. Where have you been? And I go, I'm on every day. In fact, I probably answer put out dozens of replies a day to questions. I do it by reply. I do not do original tweets or original posts very often, partly because when I put it out there as an original, I get so many people replying that it just gums up the process. So I try to do it through my replies more. I get responses to those, but not nearly as many. And so if you're not seeing me, it means you have to, and I can't tell you exactly how this, where to find it, how to do it, but you have to go to your settings and make sure you're also seeing replies. That's where most of my posts are. So, if you're only seeing me occasionally, it means your settings are restricting what you're seeing. As for my letter, I put out a quarterly macro letter. I've been writing this since the year 2000. Initially, I was on Wall Street. I was writing it for my firm to go out to clients. But in the last 3, 4, 5 years, I've opened it up to retail because I'm retired, and it's the same letter. Most people, I've got plenty of retail people on there now, tell me it's very readable, and it kind of fills out what I do on Twitter in my interviews. It allows me, it's usually 6 or 7 page quarterly letter. It allows me in a longer form to kind of explain my rationale. So it's not for everybody, but the people, I get a lot of people who subscribed for a year and re-up the next year and the year after that. So that tells me, it does add value for some people. And that you can find out about that. It comes with a cost, there's a subscription fee. You can find out about that by direct messaging me on Twitter. So once in a while I'll get somebody messaging me and saying, I can't find your letter. I can't find your website. I don't have a website. If you direct message me, I will provide details in terms of what's in, generally what's in the letter and the cost involved and how you could subscribe if you want to.
Got to go directly to you to get all the information. I love it. It's it's old school, but it's brilliant in a way. And I like these days to encapsulate a conversation in key takeaways. I find that as we're all creatures of habit, everyone loves threes. So if I was to limit you to potentially 3 key takeaways from this entire conversation and what the future might look like, what would you say those 3 key takeaways would be?
Yeah, I would say, first of all, as I think I spent enough time, I won't spend much time, but is we are late in the game. So just understand this thing can happen and then end in not that many months from now. Um, and so, you know yourself, because what what will happen for most people, I'm a contrarian who's very comfortable going against the crowd, but for most people, they're influenced by the crowd and influenced by the tape. And I can almost predict better than looking out the window and seeing rain, um, that when we get close to the top, when this market's up 25, 30%, the people who are bearish today are going to be all in and telling you why I'm wrong. It's going a lot farther. In other words, at the top, most people are bullish, not bearish.
Mm.
And psychology works that way, that you're going to be having a hard time being bearish when everybody's telling you it's good, and when the market's telling you it's good. So just know yourselves, and don't get greedy. Don't get if you're not somebody that can react against the crowd, don't wait for the exact top. Say I've done pretty well. I'm gonna not get greedy here. I'm gonna take, because the other side, the second takeaway is that the other side of the mountain is, I think, going to be very big. We haven't had an 80% bear market in my career. So, and I've been doing this 51 years. So, we were down 90% in the 1929 crash, 29 to 32. Um, this time, I think we'll be down 80%. Do I know that? No. Could it be 60? Yes. Could it be 70? Yes. Could it be 90? Maybe. But 80 is my best guess of what we're gonna see. An 80%, and that'll be broad based. So if the indexes are down 80%, you can pretty much guess there aren't going to be a lot of places that are going to be holding up.
Mm.
Most will be down similar. So that means you don't want to be late and be caught in that big downslide. Um, I'm not trying to scare people here out of the market here, because I do think there's a nice rally ahead, but I just want people to know yourselves.
Mm.
And then the third one, I guess, is kind of a general one about, um, be careful. Don't think that by listening to more people, you're going to be more, you're going to be better. Don't think that listening to all the chatter and the more information you gather, the more prepared you are. Yeah, that works in a lot of things in the market. The more you pay attention to more voices, the more confused you're going to get, and you're going to probably be led astray by somebody or several people.
Mm.
So again, it's a fine line to walk of when is information valuable to me and who to listen to. And I can't give you an answer exactly how you do that. It's a learned trait. You just more time in the market, you'll learn a lot of it probably from bad mistakes or experience. How not to listen to everybody, but it is done. I call it ignore the noise, because there is every day there's media lives off providing information or providing chatter. That they want eyeballs. They want you to be watching and listening. But that doesn't mean more information makes you a better investor. The best investors are more disciplined. Find things that are, there's different ways to do it. Some people want to play momentum. Some people want to buy out of favor. So I can't give you an answer that way, but find good stocks and good companies to invest in. And then don't think you're going to trade them. Again, we're close to an end here in this cycle. So I'm not saying don't trade it here, but generally, the most successful retail investors probably more often than not are not traders. They're people that find things for one reason or another that they like. Maybe it's in an industry that's turning around, like the metals, and then just sticking with them rather than listening to advice every other day and say, "Well, I got to get out. Somebody told me I got to get out,
Mm-hmm.
or it's going to go down." And Yeah, too many investors treat investing like gambling. It may as well be in sports gambling because they're just in and out and they don't really have a rhyme or reason.
Yeah. No, we're very susceptible these days to hearing anything and acting straight away upon it. It's a phenomenon it's affecting everyone across the world. It's not really exclusive to any one person, but it does take time and practice and sticking by your convictions in your game plan. But thank you so much, David, for coming back and speaking on the show. It's been exciting and turbulent, and I think no matter what, there's going to be ups and downs and trials and tribulations. But I appreciate you taking the time to paint a picture of what's happening in the US markets and what is looking to unfold, and hopefully get you back in the coming months or early into next year to see what's unfolding again, so we can revisit some of those predictions and discussion points we had today. But thank you so much.
Sure. Thanks for having me on, Ben.
Thanks for listening to the Market Bull podcast. Please remember that the topics and stocks discussed in this podcast are not financial advice. If you enjoyed this episode, please make sure to like, share, and follow. You can follow the Market Bull on all our socials and keep up to date with global market insights.